Welcome to the Sticks Sticks.
Okay, Steve, I'm ready. All right, good morning. It is March 18th, Tuesday, and we're going to start our prep here today for the markets. Just a quick reminder before we do get started, derivatives trading is inherently risky and past performance is not indicative of future returns. Now, we always start with the ES, so that's where we'll begin again today, and we look at all of our positioning. We also, when we go through this today, and as we go through this daily moving forward, we are going to focus on when to press the pedal on the long side, when to press the pedal on the short side, and when it's time to step back and reassess if we need to check the direction of the market and make sure that the market gets unstuck first. So we always want to start by assessing the risk in the markets, the positioning, and the flows, because without flows, in the most simplistic way, it's volume. The markets won't move in any direction. If you don't have people coming into the market, it won't move. So we need to understand those factors as well as where the risk is. And it's a big benefit to understand that positioning of the different groups of size traders. So we're going to start with the ES here. And what is going on in the markets today. And I'll show compared to yesterday here. Yesterday, our systematics were buyers in the market. We were looking for larger buying to come in from our participants as they had about a $3 billion bid yesterday. And today, that has gone away. You can see that we're down to about $10 million bid. So that is drastically different from yesterday, as well as we turn into a lot of offers. And then our line in the sand today on the ES, and this is always a critical area to pay attention to for the major line in the sand and the minor line in the sand. So the minor line in the sand is going to be at 57.15. And the major line in the sand is going to be up at 58.68. So we are well below our major line in the sand, which is where we'll bring in $21 billion of selling. And our minor line in the sand here is about right where price is. We are just over it. And so that's something we really want to pay attention to as we move forward. So the other areas to pay attention to here are going to be 57.46, 57.59, and then this large volume node at 57.63. Those are the three key areas if we're going to see upside. So from a risk standpoint, we're going to look for more rotational price action underneath here, down to yesterday's value area high and Globex value area low, and probably yesterday's point of control. That's going to frame the market for us. And if we get a breakout on either side, then we're going to look for the market to trend. And some things happening this week that we want to pay attention to. We're closing one business cycle on Wednesday and another on Friday. And if we look at the last few midweek closes for our cycles, this is back in January and then February, we had downside into the VIX closing, and that propelled the market up and sideways right before the market dropped into FOMC. And we're seeing that again. So yesterday we knew this, we were preparing our students for this, and it was likely we were going to have an upside favorite day, but not necessarily a trend day. We did talk about that with them in our midday session. We laid out that Microsoft was the key and other internal factors we were watching. And again, as soon as Microsoft turned for the day at 1:30, we had the biggest move and the most outsized move, but we didn't actually trend. So we're looking for similar today as this business cycle close. And then on Friday, we are looking again at OPEX and trillions in dollars getting repositioned. So that will affect the JP Morgan collar, and we're likely going to see a more condensed range. Other things playing a factor today. We have the Japanese rate cut decision this evening, but the big one this afternoon or this morning at 10 o'clock is NVIDIA and the uh, the keynote at the GTC. And if we look at NVIDIA, because it makes up such a large part of the market, we're going to pay attention here to this 130 strike where there's about $100 million sitting. And this may be a buy the rumor, sell the news event as NVIDIA rallied from 104 up to 120. We're going to watch this 122 half, and then really up at 127 is our big area. If we get over that, then 130 is the last thing standing in front of our 135. So 127 and 122 half are going to be the big areas when their CEO comes out to speak. And as their rate of change in growth is slowing, he will either strike a very bullish tone, trying to change that narrative, but the numbers don't lie. And again, we've gone over in our other videos why we follow the flows and why we follow the true numbers, because that's the one thing we can rely on. So that's what we want to pay attention to at 10 o'clock is that is going to be market moving. And then at 3 o'clock today, we have the president signing more executive orders in the Oval Office. And so that's, again, another factor we need to be considering as traders will want to buy protection. So if we look at where the insurance is in the market today, and we'll start here with, we have the NASDAQ and the ES. So we want to look at both because I know a lot of you do trade the NASDAQ. So on the S&P, we are underinsured or just about normal insured for FOMC, and this always goes into the red. So we're going to look for that spike, which means people buy insurance. That's that downside move. We saw this yesterday as people bought insurance. They came into the day underinsured. And then as we got fully insured, then the market could rally. And then we'll enter a week next week where there aren't any catalysts. So we won't expect that to spike. And then in a few weeks, we have a lot of job catalysts again, and we'll look for that to rise. So again, that rising will put that downward pressure into the markets. Now to compare this to the NASDAQ, and then we're going to go through our levels here in a little while. But on the NASDAQ, we are insured for FOMC. We're not insured today for the import-export prices, and we're not insured for NVIDIA or Trump this afternoon. Those are areas that we can watch for that to come in, and we watch that minute by minute. We have real-time indicators for those to pay attention to. But that's going to be something key because we don't move the market as retail traders. So all we can do is follow where the size money that is protecting trillions is putting their insurance buys or is deploying capital so that we can piggyback off of that. We can't move the market ourselves. We can understand when they're going to get involved and likely provide a bid for support or a sell for resistance for us to trade off of. And so those are the big things we want to pay attention to. This was yesterday, just to give you an example. We started way down here, and then as we saw that spike come up and everything pull up, that was that from the open until after London close. That was kind of that cycle of everybody buying insurance. And then once people were overinsured, we started that washing machine again, kind of shaking everybody out. And from a risk standpoint here, so this top one is the SPX. And right now we have the red line above the green line. And that usually portends a risk off scenario. And you can see that's what we've had. Now, this is also when we'll get the most violent moves back up. And so that's what we're going to be on the lookout for over the next couple of days. But what this tells us is we're not out of the woods yet either. This could lead to back in 2022 when we had that spike, then we had a Vanna rally, and then it continued lower. This tells us that on a longer term for risk, we trade multiple time frames, whether day trading, swing trading, multiple days, multiple weeks. This helps us to assess that risk, and we can see that on the S&P, we are not out of the woods yet. This is still a risky scenario, but we do have areas to see the bottom coming in. So back to the ES here. Again, we're going to look for that rotational price action in between those levels. And then if we go to, so for the ES today specifically, we are looking for rotational between 56.59 and 57.41 with our pivot right here at 56.99. And this is the M contract. For those of you that haven't rolled over yet, we rolled over the weekend, but you would have about a 50-point difference if you're still on the H contract. Our low end of the range, we came right down to, and you can see we bounced off of that last week. We were coming right into there, and one of our other educators was explaining why he covered his short position there, because that's where we knew large amounts of capital would be deployed and the risk reward was skewed. And right when we came down there, then the markets rallied aggressively since. So our rotational zone tops at 57.41, and if we get over that, we're looking for 57.84 and 58.06. Neither of those is back to our major line in the sand. So that tells us, again, heading into FOMC, we will have a riskier scenario, which tells us bigger ranges, which is good for our day trading because we need volatility and wide ranges for us to capitalize in the markets. So now we will go to the NASDAQ again, and we are insured for tomorrow's events, but not for today's. So that could put some downside pressure into the NASDAQ. But when we look overall at the market structure on the NASDAQ, we did go upside yesterday. We went trend up. And we are going to look for, again, rotational price action, similar to the ES. Again, those are correlating fairly well right now. If we look at our correlations as they are, we are at a 0.92 or 0.99 between the ES and the NASDAQ. Some things to pay attention to, and we'll get into these other instruments here, is the Russell and Dow correlating strongly. That's normally not a good sign. They have entirely different components. One has large cap, one has small caps. One is, more directly affected by interest rates. The other is not. And so when you see a strong correlation there, that's usually everybody selling everything at once or the start of a trend. And so as we've seen that picking up, that's, again, why we expected this down move to have more legs to it than the last several this year. Also to note, the dollar is a perfect inverse correlation right now to the euro. So we laid out on our COT video that trade on the euro from 105, 104 half up to 108, 109, and that's an easy trade, especially with the correlations that we're seeing. So the NQ and the ES are correlating very similarly. And so again, we're seeing the same thing. Came down to our low end of the range and we started to bounce. Now we're looking for rotational today, 20,068 to 19,750. And our pivot is about where we pulled back to here at 19,912, which if you look at the cursor is yesterday's point of control and Friday's value area high. So this is going to be a key area to pay attention to. Yesterday's rally was on very weak volume overall. And so again, when we talked about we need those flows, we need that to come in, what this tells us is this is less capital deployment and more short covering, as there are less people wanting to buy at these prices, wanting to transact. So we are on the lookout for a spike in volatility. We are on a lookout for insurance buying to come in. Those are the downside pressures. But with FOMC tomorrow, this is the dealer's best chance to get the market back up to a more neutral state for them. And We can see here, we look at multiple factors when assessing the risk in the markets. And you can see when the market started to go risk off, everything was going white, telling us, around the 18th, the 19th, 20th to not be looking for any longs. And then finally, last Wednesday, it started to turn up and we could look for that upside. And then when we look at our momentum and trend and cycle factors, it has been saying upside as well. So that has been giving us that green look for the long side and telling us only to look longs for right now. So that's where we'll look for that today would be this 19,910 right at our pivot. At that lower of that rotational level, we'd look still for long. And then if we get a breakout over 20,076, staying under that, we will look for the short side to show up there. And again, with all the factors coming in this week and FOMC coming, we are looking for traders to be less likely to really push this market and to keep it more contained as we come into tomorrow morning. So today is the last chance really for a moving day. Tomorrow, we could see a move right off the open, but then we're likely getting rotational until Powell comes out and speaks. And if we go over to commodities, the most bullish of the commodities have been gold and copper. And when we think of correlating markets, and again, with all of the catalysts coming, China has the People's Bank of China has their rate decision, as well as the Swiss Bank and the Bank of England. So we have those three coming on Wednesday evening. But we've been monitoring copper and China as we laid out in our room since November, that this is very strongly correlated with the Hang Seng. So this is a chart of the Hang Seng, the Chinese market, and then this is a chart of copper. And you can see that they both start to rally around the same point. So China put out QE, trying to push their economy back up, and we see copper going again. So we're always on the lookout, not for trading a single instrument, but where the easy money trades are. And if you understand what, these correlations, and we had sent this out yesterday morning, around before the open, around 9:20, but we had listed that BABA and tickers BABA and FUTU would be the big ones because they are large caps in the Chinese market. As we're looking for copper to rally, we can look for those equities to rally. So we can correlate these between multiple indices and see where these are really going to turn. And so copper has been in this upside move, and now it's getting into the late stage of it. But you can see here, everything is blue, telling us still more upside coming. And we just broke the $5 mark. So that's going to be key today. We saw this with natural gas. It made its move up towards $5 and then had a nice pullback. And we're still looking for pullbacks to get long on natural gas into. Volatility is coming down. Volume is dropping a little bit here on copper. So this upside move is beginning to run out of steam, but we're waiting for that blow off top. So we are still looking on copper. We're rotational today from $5 to $4.92. As long as we hold over $5, we're going to target 506. And if you are unfamiliar with copper, it does have similar tick value to the ES on a tick by tick basis, but there are a lot of times tighter stops that you can get depending on your trading strategy. And the other one that's really been breaking out has been gold. We have some traders in our room that are long either the futures or long via options. And we are coming up to the top end of our range here at 30.50. Now on gold, we always do watch our line in the sand as well. And for right now, our line in the sand on gold is at 28.40. Our upper target where dealers will begin to sell aggressively is at 31.01. So while our daily range is topping out at 30.50, we still have room to get up to this 31. And again, we are in that late stage upside. So we want to be looking for longs more than shorts and looking for really profit taking and buying the dips. This is different to what we're seeing again on the ES or on the NASDAQ, where we're now starting that upside move, but we had been in that downside for quite a while. And then we hit that late stage in the dark red, and that tells us we can start looking for that bottom to be coming in. So those are the main instruments that I know most people look at. We'll also do oil really quick and hit on that. Again, oil, we laid out, I think it was 2 weeks ago. We came down right to our line in the sand. It actually broke it. And oil very rarely goes below the line in the sand. So that is always an area. When we came down here for a couple days back at the beginning of the month, that tells us to look for the longs. That tells us that the bottom is coming for oil. And now we've made a nice 3 to 4 point move off of those lows, and we are seeing the same thing, looking for that upside. So we hit our bottom in here, and then that's when we want to be positioning for the long side, looking for those areas to go long for when that rhythm in the market changes. So we are looking rotational today on oil 68.08 to 67.02 with our pivot at 67.55. If we get over a rotational high, which we're right at right now, we are looking for up to this 68.70 to 69, which will be about this point of control from where the sell-off started at the very first day of the month, the opening part of the month. And again, with two business cycles closing, one tomorrow, one on Friday, there are the reasons to see this get a push as well. On the downside, if we do break our rotational low, we're looking at really coming back into the $66 range in this untested point of control from 66.30. But we are starting to see improvements on most of our longer term models here, and our short term models already started their turn before. And then lastly here, the only thing we really want to focus on is making sure that you understand when something is in play for single direction versus when something is not. We want you to understand when to push that button. So when we think of the ES, because that's always where the easiest, the most analysis is done, and it's the most liquid market, is once we get over our line in the sand, which again is way up here at the 58.70 area. That is when we favor longs. And so that's when that buy the dip can come in. That's when we can start looking for more upside. Underneath that, we can see the bigger ups and the bigger downs. And you'll hear that in bear markets, there are big up days and big down days, and there are business reasons for that. So we go into that with our students in depth, and they get access to all the real-time indicators for this that we have and our proprietary indicators as well. But for now, make sure you are on guard for any risk events because tomorrow's a big one. And then we have Thursday and Friday with OPEX coming on Friday. And then next week, we get a little bit of a lull. But there's always things that could come out from the Oval Office. There are always exogenous events that nobody's preparing for. But next week should be a little more favorable. And then the beginning of April, we go back into that big risk mode. So if we don't get over our line in the sand, be ready to protect yourself and protect your capital, as we could see a continuation through the next business cycle that would go until the Easter holiday when the markets are closed. So have a great day, everybody. Remember, the number one thing we control is our risk. And if you are interested in learning to do this for yourself, we just started our newest set of courses, so we'll be starting more in the fall. But check us out every day as we'll be doing these, trying to get you prepared for multiple markets and where the trades will be.